Alright, so exercise 6-7. It says Hemming Company reported the following current year purchases. And sales for its only product. Hemming uses a perpetual inventory system to determine the cost assigned to ending inventory and to cost of goods sold using FIFO and LIFO, and also compute the gross margin for each method, round amounts to cents. So they gave you the chart here, right? Showing you what they started with, what they've sold, and what they purchased over the period. And we're going to start with FIFO, right? And so January 1st, they had beginning inventory of 200 units, right? And at $10, which equals 2,000. And then the sale itself on January 10th, they sold 150 units, and they sold it at $40. But that point, that part for us is irrelevant until the end. So beginning inventory, 200 units at 10. And then January 10th, we sold 150 units. Well, we sold 150 units, so we automatically have to pull them from where?
First.
The beginning inventory, right? So we do 150 at what price?
$40 each.
What did we pay for them?
10.
10. So that equals what? 1,500. And that means we have remaining inventory of how many units? 50 units, and at $10, right?
500.
So we have 500 right now. And then what's next? March 14th, they purchased 350 more units, right?
Hold on a moment.
350 units at $15, which equals 5,250. Then on March 15th, they had a sale, right? No. So over here, 300 units. So 300 units. And where do we pull them from?
The beginning. The 350.
Yeah, but how many units from where?
50 from the first.
50 from the first. So
That's $10.
50 at 10, and then the other 250 at what price? $15, which means that we had how many on hand left? 50.
100. They bought 30. Bought 200.
100. 100 at 15. And did they sell any more after that? Yeah, October 5th. So now July 30th, they had a purchase again. And they purchased these units. They purchased 450 units at $20, which makes it worth 9,000. These 100 units at $15. How much is the inventory worth? So 1,500 plus that 9,000. And then on October 5th, what did they do?
Sale,
Sold how many units?
430.
430. Where did we pull them from?
The remaining of the 100 and
So you pull the 100 from beginning, well, what was technically beginning, right? At 15, and then the other 330 at $20, which means that you have how many left in inventory now?
none.
Sure.
What do you?
You only took 330 from where? From 450. So you have how many left?
120.
At $20, which equals what? Who don't have a calculator in here? And why?
140.
120 times $20 is not
Oh,
140.
damn. I thought you was at 120.
2,400. And so that's the value of inventory right now. And then on 10/26, they purchased more, 100 units at $25. So now they should have a total of 220 units left. And that stems from 120 at $20 and then 100 at how much? $25. So what's the total value of this inventory right now? You said this was 2,400, right? And then clearly this is 2,500.
What is this thing?
4,900, right?
Oh,
24 plus 25. Now this is under FIFO.
hold on. One at 24, one at $20, and one at $25 per unit. Mhm. What does the chart say for October 26th?
Can you repeat the question?
What question? Somebody just asked a question. And I'm having fun. Okay.
So now we're doing the same part and we're using LIFO this time.
So under LIFO, same thing. January 1st started off with beginning inventory of 200 units at $10, value 2,000. And then on January 10th, they sold 150 units. Where do they pull them from? They only have one place right now, right? So at $10, which equals 1,500, right? But now what we have left is how much? 50 units. All right. And then on March 14th, they purchased 350 units at $15, which equal 5,250. Now, what we have on hand is still the 50 from previous, right? And we now have 350 at 15. On March 15th, they sold how many units? 300 units. And where do we pull them from? This is LIFO, last in, first out. This last purchase, right? So we're gonna do 300 at what price? 15, which equals how much? How much? 4,500. And that means now you have 50 left at 10 and 50 left at what? 15. Now on July 30th, you purchased 450 units at 20. So now over here, that just adds on to the count, right? You have 450 now at 20. October 5th, you sold how many? 430 units. Where do you pull them from?
450.
The 450. So, hold on, 430 at 430 at 20, which equals how much? 430 at 20, how much?
8,600.
8,600, which means you have how many left in stock? You still got the 50 at 10, the 50 at 15, 20 at 20. And then lastly, October 26th, purchased 100 units at 25. Now you have these left as far as inventory is concerned, and all of this values out to what? We know this is 500. This is what, 750?
750.
What's the total value? What's this amount?
4150.
4,150. Alright. Next one was exercise 6 dash what? 10P.
Oh, yeah, 10, 1 second.
You know, watch the tutorial, you know.
You got something?
Ready now?
No. You got 750 or 950?
750.
Okay.
So when it says, okay, so the FIFO and the LIFO, so when we're doing the first, last, and how, like what order do we go in?
Whatever was
First.
first purchase. So whatever was purchased first is where you put sold, where you pull sold units from.
So like the old.
So whatever you purchase first, and then like it would be whatever you purchase last.
So like
Okay. Exercise 6 dash 10. Lower cost of market, which is what we went over today. Martinez Company's ending inventory includes the following items. Compute the lower cost of market for ending inventory applied separately to each product. So you got helmets, right? And how much did they pay for them?
$50.
They paid $50 a unit. They had 24 units, right? Times $50, which means the total cost for them was how much? And then the market cost was how much? Instead of $50, it was what? $54, which means that the market says it's worth how much? Say it again.
$12.96.
1,296. So what's the lower cost of market here? Which one do we go with? What's the lower cost of market?
The 1200.
1200. Bats. They had 17 units and at $78, which means they paid how much for them?
1326.
$1,326. Those same 17 units, according to the market, are worth $72 per unit, which means the market said it's worth how much? 1,224. So the lower cost of market would be what? 1,224. Shoes. 38 items. The price they paid for them was $95, which means they paid a total cost of how much? $3,610. Whereas the market says those 38 items are worth $91 each, which means that the market says it's worth how much total? 3,458. Lower cost of market, 3,458. Uniforms, you got 42. It says we paid $36 per uniform, 1,512. The market says those 42 uniforms are worth 36 as well, right? So lower cost of market obviously can only be 1,512, which means the total lower cost of market is how much? Add that up for me.
What's that last number on the bottom?
1,512.
7,394.
7,394.
The lower cost of market, is that just the way the inventory, or is that something that
Say it again.
the lower cost of market, is that like a rule that they can't charge too much for it? I think you charge
No,
anything you want to charge.
no, that's the rule of accounting. When you're valuing inventory, you only take the lower cost of market. So just because you might have paid 500 for it, if the market said it's worth 3, that's what you value it. It adds it's 300.
That's the book value. Compared to a blue book value of a car, something like that.
Yep. It's probably actually the exact same.
So if a car dealership is valuing out there and they're bringing in new cars for the next year, how's their cost effective, just in relation to what they have to value that vehicle at?
It depends on what the value is. If the value is higher, then obviously that's a good thing. If it's lower, then they lose money on what they didn't sell.
So the value is better than cost? You're saying what they
Yeah, if the market's saying that it's worth more than what you actually paid for it, that's a good thing. If the market said it's lower than what you actually paid for it, that's the bad thing, and that's when you lose money. This is why it's so important to choose a inventory costing method that's gonna work well for your business. And the fact why dealerships probably go according to FIFO so that they can get the new inventory out first, so they don't lose a lot of money on that. Because the market fluctuates about a second. So they try to do the best they can with estimating if they can hit the nail on the head or if they may lose a substantial amount of money.